Hello, everyone. Welcome again to another time around. I've got a stock pick for you. I don't know if you've heard of this company, Enlight. Goes by ticker symbol LASR, but I'm going to show you the trade pick I've got set up for it. And let's just jump right to it. I'm going to go to my slides here, let you know. Edgefinder gives out these trade signals. I get over 100 of them a night. And they come out just like, an hour to 30 minutes to an hour before I come on with you. So you are hearing these things just as soon as it's possible to hear them. And what they are is deep machine learning generated trade signals that have a historical edge and a out of sample edge of 2 years. For statistic geeks, that just means back testing and forward testing, you know that. So what I've got tonight is a trade on LASR, and you want to get in any price below 69. You want to set a stop loss at $5.59 lower and look for a target of $11.55 higher. That's the setup. Now, the thing about that is that typically a setup that requires you to risk one compared to making two. All right, this is really a thing that a lot of people don't know. If in fact you make that trade 20, 30, 40 times, you're only going to win that trade 33% of the time. Now, that's not me picking on any sort of technical analysis. That's just the theory that prices are random. Option market makers, they work on that assumption. They build their pricing models, everything, right? So in other words, it's just as easy for a given stock to go up $1 as it is to go down $1. If you set a stop and a target $1 each, higher and lower, you got a 50-50 shot. But if you set a stop at $1 and a profit target at $2, that's risk one to make two. It's twice as hard for the stock to get up to $2. In theory, all movement being the same, that would tell you that you only have a 33% chance of winning that trade, right? That's what this trade is like. It's about risk one to make two, somewhere in that range, just a little more than two actually. So it's maybe a 32% chance of winning, all things being equal. However, this trade I'm bringing you tonight actually has a 40% chance of winning according to Edgefinder's deep machine learning setup. That's the whole bit. I bring you trades that have a statistical chance of outperforming random odds. Now this one here, think about it. This is like walking into a bar and a guy says, I've got a three-sided coin. Okay, I don't even know what that would look like, right? We got heads, tails, and blip. If in fact it lands on heads or tails, then I win and you pay me $1. But if it lands on blip, then you're going to win $2.20. Now you think about that. If you pay attention to what's going on there, you realize that game has got a little bit of an edge in your favor. You see how that works? You're only going to win 1/3 of the time, but your wins are going to be big enough to make up for your losses. So assuming you got enough cash on hand, and you can play this game with this guy long enough, you could end up on top. That's the whole idea, the analogy behind this particular trade setup. Now, if you want to trade where you're guaranteed to win 70, 80, 90% probability, something like that, this is not your trade. But if you're in for a trade that when you do win, you're going to get a lot more than you risk, and you've got a slight edge to it. This has got a 7.5% edge. Well, then you should want to pay close attention. Here's the chart. Now I've got this thing set at about $64 as an entry because I like the idea, even though Edgefinder says anything below 69 would be great. Well, down here at 64, you see a $5.50 stop loss goes all the way below recent resistance and well into the gap that was caused by the earnings. Earnings just a week ago, and it was good news earnings that surprised people. This company is making more than expected. It shot up, and then all of a sudden it's had a couple of days of sell-off, right? But today was really interesting because it dropped way down and came back up, meaning there's buyers in this territory. Now, the nice thing about that is Edgefinder comes along and says, based on this setup, the historical pattern of this stock, when it has stuff going on like this, is that it's more likely to go up by double than randomness would suggest. It's not more than 50% likely, but it is about 40% likely, and that's a big deal for a risk one to make two stock. So that is that's the setup that we got. Hopefully, I'm coming through here. Are you able to hear me clearly enough, or does it need to be a little louder or anything like that? How's this? This any better? Well, okay. Excellent. Okay, so that's the trade setup for this week, for this Thursday. We'll come back and revisit and see how it did. But it's a trade where if, in fact, it does hit its profit target, you might even be able to let it run. This is a sort of trend-following trade, and we've already got a well-established trade. We've got a well-established trend. We've got a catalyst that has just hit with earnings. We've had heavy selling. I mean, you know what that is, right? That's institutions like, oh, sell the news. That's good news. Let's take our profits. Let's be done with our position here. You would expect the stock should just come crashing down, but notice it hasn't. It's come down from, its highs, but it's still above its recent high there before earnings. So there's buyers here. As soon as the sellers are done, up the price goes. That's kind of the idea. But I want to tell you about something else I've been doing. We've been doing this on Wednesdays. We did this yesterday. We talked about the Gamma experiment. In fact, I traded live trying to look for the Gamma experiment. And we had a really interesting trade. We put on 3 different trades, and one of them made a surprising gain. I kind of want to take you through that here, but before I do, let me explain. If this is the first time you're here, what is the Gamma experiment? What is the market's big gamble? Well, it is that they're putting out 3 times a week expiration options. Not quite every day, but they're getting there. They'll get there. If enough people are interested in this kind of trade, and you can bet they will be, then they're going to eventually have options that expire every single day on the Mag 7 stocks, or the more heavily traded one. I don't think they have one on Broadcom, even though it's considered zero or Mag 7. But whatever, you don't want to trade them. Spreads are too wide on AVGO. The ones that spreads are good on: Apple, Amazon, Tesla, Google, Microsoft, Meta. Those are the ones in addition to SPY, IWM, and QQQ. Now, on Tuesdays and Thursdays so far, it's just the 3, SPY, IWM, QQQ. That's been going on now for a couple, 3 years. And these 0 DTE options are really interesting because for option buyers, they offer the opportunity of high gamma. Option sellers, market makers, they hate this stuff. It's huge risk for them, especially in today's volatile market environment. And so putting on more 0 DT options is a big experiment. Can market makers really weather the change that's happening? So if I'm talking Greek to you, well, there's a reason. Gamma is one of the option Greeks. You can, Google it or ask your favorite large language model what the heck it is, what option Greeks are. But let me give you just the 50-cent explanation. Gamma just measures how fast an option price will accelerate. Okay, so the higher the gamma, the more rapid the change of options. Okay, there are three characteristics that tell you when you have the highest gamma. First is whether or not you're closer to expiration. The closer you get to the day of expiration, the higher your gamma scores go. And the highest gamma scores, of course, no surprise, are on the last day of expiration. That's the whole allure of zero DTE, 0 days till expiration, same day expiration, call it whatever you want. These kinds of options have the highest gamma. Number two is whether or not it's closer to price. Interestingly enough, this actually makes more impact. Which option strike you choose has more impact than, which day of expiration you're trading on. Although the first one matters, this one matters even more. So if you buy an option that is right next to the stock price, the strike price of the option, is 300 and the price of the stock is 350 cents or 299 and 50 cents, something like that. The option strike price you're working with is as close to the stock price as possible, usually just beyond it for higher for a call, lower for a put. Closer to the price, higher the gamma. Number three is whether or not it's later in the day. You start off early in the last day, the day before or the day of expiration, your gamma is higher than in other days. But if you wait a few hours, it rapidly increases even by double into the last 2 hours of the session. So those are the perfect times that we like to try and trade these zero DTEs. Now, when I say trade here, I'm talking about buying a call or buying a put. None of this fancy schmancy selling long short iron butterflies, all this stuff. Those are for the option market maker type traders. Those are people that want to collect theta. Those are the people that can say, that believe they can say, hey, I don't think the price is going to go beyond here, so I'm just going to sell these options and collect the premiums as they go worthless. Okay, and that works most of the time, except when it doesn't. And lately, with a volatile market, it hasn't worked a lot. Instead, what you get is the effect of this gamma pushing prices farther than the cost of the options. So an option might be only 25 cents, and yet the underlying stock makes a $3 move. So a thing like that, you buy that option, you only have 25 cents of risk or $25 per contract, but it could make you $150, $200. So again, we're back to the analogy with the coin flip game, where your payout is bigger, even if the odds end up just about the same. All right, so all three of those, zero DTE, at the money strikes, and last 2 hours of the trading day, combine those together, and you have an extreme opportunity. But what you need is the ability to choose a price that could be meaningful as a reversal point. You need to have an idea, where can I enter my trade that the price might reverse its current trend, and how can I get an idea of how far it will go so that I know it's worth trying to make the trade? That is the experiment we're trying to put on here. The Edgefinder tool is giving us signals that tell us a region and a zone of a target, how far we think it should move, and then we have some tools to say, here is where we think the opportunity to enter the trade is good. And so, as an example, back on February 18th, I captured this because this was a trade I actually did. And Google moved up and down just 1% that day, from about 301.5 to 304.5. $3 move on a $300 stock, 1%, right? This is breathing in and out. This stock is not doing anything crazy. This is a quiet day. And yet, if you were to buy a call option, the 305 call option that expires clear out 45 days out in March, on March 20th, then what you would get is a movement in price that can go up and down by quite a bit. It can change by as much as 10%. And there at the very last, you see that 0.5% of a move up on Google turned into a 10% increase in price on the option. However, let's compare what happens when you change the option you're buying to a 0 DTE option, an option that expires on 2/18, and an option that is at the money, that is really close to where the price is. So Google was at 301 when, in fact, this signal was emerging. What if we bought the 302.5? Well, here's what would happen. You could buy that thing under 10 cents a share, and it goes clear up to $1.50 at its peak. So it has a 1,200% change. Same move, same 0.5% move, but an option now that increases in value by 12 times. Now, of course, it comes back, clear back to 70 cents, so it's only 700% move. But you can see, if in fact you can make this trade, if in fact you can win this trade, anything close to 40 or 50% of the time, the occasional large winner is going to make it worth your while. And this is true for both calls and puts. Here's another trade. This was on IWM just a few days ago. And what we had here was a really good demonstration of how the price has bigger impact later in the day than early in the day. Look at this chart here, and you'll see early in the first 2 hours of the market, we had two moves, $1.50 down and $1.30 down, just like inside the first 2 hours. If you were to look at the money put option, you would see that went up by 150% and 110% respectively. Not bad moves, right? But then late in the day, we get another move, similar, but not quite as far, $1.20 down. And yet the option at that late hour of the day goes up in price by 230%. So it has double the impact on even less, just slightly less of the move. That's the power of these kind of option setups we're looking at. The gamma factor rises so high that these option prices move so much. I just have to have some sort of forecasting tool that helps me recognize, hey, am I going to get $1 or $2 move out of this thing? What could tell me whether or not this is likely to move that far? Well, that's what Edgefinder is all about. In fact, let me show you my chart and show you just what happened today on QQQ. So here we are. This morning, before the market opened, I put up this box onto the QQQ chart. This is what I call the dead zone. The dead zone is like a heavy attractor, a black hole, right? Prices head towards it. Now, you can see it opened and prices went up and then they went down. Here, prices went away from it, right? That's my opportunity. If, in fact, I can see, hey, here's a moment where I think prices are going to move back to the dead zone, then I have an opportunity to make one of these trades. And, in fact, the later in the day I get that opportunity, the better. Look what ended up happening. I saw the price right down here, just under 604 after this green candle went up, and I thought, that's it. That's the level. If you could make a trade along those lines, you'd be able to really have a small amount of risk and a large amount of return. So just as an example, the price is around 603 at that point, or 603.50. the price, the strike price that you would like to be able to get would naturally be the 604, the first one that is out of the money. This would be a call option. So you'd be looking to buy a call option somewhere here in the last 2 hours of the market. And if you had done so, here's the interesting thing. You could have picked this thing up right in here, anywhere under that line, somewhere right up there from 13:15 all the way to 14:30 Eastern time. So let's see, 11 to 14. Yeah. Okay. So what you would get early on, the price was about $1, and then it got lower and lower, even to the point where right around in here, at its lowest point, the 604 option would have been available for 75 cents a share. Now, you'd have to be genius to be able to know to buy right there. But like I said, I marked this at 604, and what we were able to do is recognize that this was a spot to get in at the 604 call, and we would be buying at, let's be generous. Let's say we didn't get in very good, the best possible pricing. We had to pay $1 for that option. All right. Well, when the market closed up here, what was the value of that option? Well, it was, let's see here. I'm sorry, I got to put it in a time frame. We'll call that 13:30. And then we're talking about 15:55. It is, let me see what the price shows there. Yeah, $4.75 is where it traded. So think about that. This trade, even if you hadn't gotten in very well, I mean, this you get in here, you can get into 90. Down here, you're probably around 85. Down here, you're all the way down to 75. Here, you might even be still at around 80. But even if the best you did was get in at $1, right? You're about to risk $100 per contract. And then this move comes along, and it's worth $4.75 by the end of the day. Now, you could take profit anywhere along the way on this particular as it happened, right? In hindsight, of course, we look like geniuses because we're picking out this trade and trying to say, yeah, well, here's how it would have worked out. But how did I know that there was the possibility for it to go from 604 up to 608 and change? The dead zone. It's the size of the dead zone that tells me my target, $4.46. If I'm down here, $4.46 is possible. If I'm way up there, $4.46 to the downside is possible. See? I don't want to make any trades inside the dead zone because, it could go either way. But if I'm below it or above it, that is where I have the statistical edge, because in those last 2 hours of the day, prices are going to converge towards the dead zone. That would have been a fantastic trade to make. I did not make this trade. I'm not going to try to pretend that I did, but it was a great example because it was today. IWM wasn't quite as good, but it was still there. You could have got this below 255, and it goes up to 256.97. Doesn't quite hit that $2.42 target, but it comes close. However, here's the trade I did make yesterday. Yesterday, I bought the 262 put option at 14.42. When it crossed up over this line, I bought it for only 17 cents. I said, okay, this thing at the dead zone's clear down here. It has a $2.38 target. These trades don't always win. But when they win, they tend to win big. And so if, in fact, you were to have held on right until the end of the day, this trade did really well. It got up to 40 cents. 40 cents. So if you had done like I did, hold on, and then you sold it you'd have to sell it. Well, actually, you don't even have to sell this one because IWM trades 15 minutes after the New York bell, right? So you could have sold it later, into 16.10, 16.5, 16.10, something like that. But I didn't wait that long. And this is the price you got, 40 cents. And if you waited for another 5 minutes, it could have been even better. But 40 cents is still more than double, right? That's 140% return on this. You're only risking $17 per contract. If you buy 10 contracts, you're only out $170, but when it's done, it's worth $400. Pretty cool, huh? That's the gamma effect. And this is real. This happened just yesterday. Earlier in the week, we saw other similar situations. We had a dead zone that was above the price and had this huge move up, tailed off at the end of the day, and didn't quite get the sort of extra edge pricing we're hoping. So I did make a trade on that day. Here's one where we did make a trade, and it was fantastic. We got in at 29 cents, got out at 92 cents. This was really useful because, let me zoom in on this one. This is one where the target helped us know precisely when to close off the trade. So we got in here at this line because this sort of bump on the Keltner channel helps us recognize this is statistically unusual that we're there. We also knew the dead zone was down here, so the direction to make the trade was going to be down because we're above it. So using a put option. At this moment in time, 14.55, the price of the just out of the money put option, 264. So 264 is just above this, right? We could get that for only 29 cents per contract, or 29 cents, $29 per contract. And then it dropped down rather fast in just 15 minutes. The target we were looking for was $1.12. That's that green shaded area. And so once it hit our target, we put the stop loss up really tight. And when it went down and came back up, we took the profit at 92 cents. Good thing, too, because it went up for the rest of the session. So that target is really helpful. Once you hit the target, you bring a tight stop loss, let it run if it will. We just saw the 400% one, right? But if it comes back, just take the profit. 29 cents turned into 92. Look at that. You could lose 2 or 3 times if you're going to get a winner that size, right? But so far, my win rate on these is about 40%. Not all of them are this big of a winner. Some are smaller. But the losers, there's only so much you can lose. That's the setup. Okay, well, I just wanted to give you an idea why the gamma experiment is so interesting, why I'm excited about it. And if you come back on next Wednesday, then you'll see me trade it live. And I invite you to just look for Quasar Markets on that Wednesday. Until next time, everyone, take care and trade well.